Hello and welcome to today's Facebook Live session. If you're watching it live, type live in the chat box, and if you're catching up on replay, just type replay. So I'm thrilled to have you all here today. We are diving into a vital tool for every investor, that is understanding your investment risk tolerance. It's crucial for generational wealth creation, and I'm here to help you understand it step by step. Before we begin, I have an exciting announcement. Don't miss on our upcoming webinar on tax planning with CA Sanika Vankadia, Director of Prospero Wealth Private Limited. It's happening on Saturday, 20th of January at 11 a.m. It is a must attend for anyone who is serious about optimizing their investments. Make sure you invite your friends and relatives for this informative session. Now, let's start our journey towards financial well being. And remember, stay with us till the end for a special case study and a quote that could change how you view your investing. So, the first segment is understanding risk tolerance. Firstly, what is risk tolerance? It is your ability and willingness to lose some or all of your original investment in exchange for a greater potential returns. An investor with high risk tolerance is more likely to invest in high risk assets like stocks, while a low risk tolerance investor might prefer safer options like bonds or fixed deposit. Now, a quick question for all you. What kind of investments do you currently prefer? High risk, moderate risk, or low risk? Type your answer in the chat. Now, the second segment is assessing your risk tolerance. How do you assess your own risk tolerance? It's not just about how you feel about risk, but also about your financial situation and the goal. Here is a quick step-by-step guide to help you assess. First, understand how much time you have in the hand. That is your time horizon. Your investment time horizon is the period you expect to hold an investment before needing to liquidate that money. A longer time horizon often equates you can take a higher risk. That means you have a higher risk tolerance because you have more time to recover from the potential market up downs. For example, a young professional, say 25 years old, he's saving for his retirement. He has a longer time horizon, possibly maybe 30, 40 years. This allows him to invest into higher risk, potentially a higher return assets like stocks or equity mutual fund. In contrast, someone who is, say, just nearing the retirement, just say 60, he has a short and he may prefer to invest his money into bonds, fixed deposit to protect his capital. Second one is evaluate financial situation. A solid foundation is the key to taking on investment risk. If you have substantial emergency funds, say 6 to 12-month expenses, and no debts or minimum debts, you can comfortably invest into higher risk investment. Example, Priya, a 35 years old, she is well funded. She has well funded emergency account, and she can invest into riskier assets like stocks or real estate. In contrast, someone who is having high debt levels and no emergency fund should prioritize his financial stability and may offer low risk investment. So third, set clear goals. Identify specific financial goals that can significantly influence your investment style, your investment risk tolerance. Long-term goals like retirement, child's education can allow for more risk, where there is a time to combat the market volatility. For example, a person who is saving for his child education, who is 18 years hence, he can invest into diversified portfolio with a fair amount of risk, whereas short-term goals like saving for a car in the next year would necessarily have a conservative approach, focusing on conserving the capital. He should invest into fixed deposit. Next point is experience and comfort level. Your experience with investment and your comfort level with the market fluctuations plays a critical role in determining the risk tolerance. Experienced investor familiar to the market cycles may be more comfortable with the ups and downs of higher risk investments. For example, Yatin, An investor who has been actively investing in the stock market for 10 years is likely to be more comfortable with the inherent risks than Meena, who is just starting out, and she may find the volatility of the stocks upsetting. So, a new investor should ideally start with the lower risk investment, gradually increasing their exposure as they gain experience and confidence. Now, think about your own financial goals. Are they short term, long term, or a mix of both? Share your thoughts with us in the chat box. Let's look at a case study. Meet Rohit, a 30-year-old software engineer from Bangalore. He is new to investing and he wants to build a substantial retirement fund. He has a stable job, a growing emergency fund, and is comfortable with technology. After checking his risk tolerance, Rohit realized that he can afford to take moderate risk. He diversified his investments into everything: stock, mutual fund, some fixed deposit. This balance helps him aim for higher returns while managing potential risks. Rohit's story is a classical example of how understanding and applying risk tolerance can lead to informed investment decisions. Now let's come to the segment 4. Importance in generational wealth creation. Now, why is understanding risk tolerance crucial for generational wealth creation? It helps in crafting an investment strategy that aligns with your long term wealth objective. By balancing risk and return, you can aim to grow your wealth steadily over generations, ensuring financial security and legacy. Uh, I'm in the next post I'm giving you a quiz to find out your risk tolerance. Don't forget to check it. So as we wrap up, remember this quote by Warren Buffett. Risk comes from not knowing what you are doing. Knowledge of your risk tolerance empowers you to make informed decisions. Don't forget to join us for the tax planning webinar with CA Sanika Wankadia this Saturday. Bring your friends and family for an insightful session that could revolutionize your financial planning. Before we end, are there any questions? Feel free to ask in the chat. And if you found today's session helpful, do share it with your network. Your support encourages us to bring more such content to you. Thank you for joining me today. Let's meet again in our next session. Until then, happy investing and take care.